Are you tired of working harder every year but never feeling like you're moving forward? You earn more than you did 5 years ago, but somehow your savings account looks the same. Or maybe you're still drowning in debt. If that sounds familiar, you're not alone. Here's the truth. Wealth isn't reserved for people with six-figure salaries or big inheritances. It's not about being lucky. It's about having a plan A strategy that uses the money you already earn as fuel for growth. Most people believe the myth that you need a huge paycheck to become wealthy. That's why so many people give up before they even start. But the reality is simple. If you know how to manage your income, if you know how to make smart choices with what you already have, you can build wealth from nothing. This is what the passive path is all about, not overnight success, not lottery wins, but clear steps anyone can follow to take control of their financial life, because when you build wealth the right way, it lasts. In this video, you'll learn how to budget without feeling restricted, how to save money in a way that actually grows, how to invest in assets that make money for you, how to crush debt and never fall back into it again, and how to build skills that increase your income while your investments work in the background. If you stick with me until the end, you'll walk away with a blueprint for becoming a millionaire, starting with just your salary. It's not magic, it's discipline, and it's proven. So let's start with the first and most important step, the foundation that every wealthy person masters: budgeting that actually work. When most people hear the word budgeting, they think of restrictions. They imagine cutting coffee runs, canceling every fun subscription, living in constant sacrifice. That's the wrong way to see it. Budgeting isn't punishment, it's freedom. It's the tool that gives you control over your money instead of letting money control you. Think about it this way. If you don't know where every dollar is going, you're not in charge. Your bills, your habits, and sometimes even your emotions are running the show. Wealthy people understand this. They budget because it allows them to tell their money where to go instead of wondering where it disappeared. Start with something simple. Divide your expenses into two buckets: essentials like rent, groceries, utilities, and transportation. Then non-essentials like streaming subscriptions, takeout, impulse, Amazon purchases. Once you see where the money flows, you can set limits for each category, not to punish yourself, but to balance the present with the future. Enjoying life now while still setting aside money to build long-term security. Here's a real example. A couple making $60,000 a year discovered they were spending over $300 a month on random subscriptions and unused memberships. That's over $3,600 a year. By cutting those out, they freed up money to start investing in an index fund. 10 years later, that decision alone grew into more than $50,000. Budgeting also means planning for the less obvious expenses like car repairs, holiday gifts, or annual insurance premiums. If you include them in your monthly plan, you won't be blindsided when those bills arrive. At first, a budget can feel tight, but over time it becomes second nature, and once you see your savings account actually growing, the feeling flips from restriction to empowerment. Budgeting is the foundation. It's the habit that makes every other wealth-building move possible, because if you can control your spending, you can control your future. And once you have control, the next step is to build protection. That protection comes from saving. Saving money isn't just about stacking cash in a bank account. It's about building security. It's about creating options. And it's about letting time work for you instead of against you. Most people think saving is boring. They see it as delayed fun. But saving is what separates people who are always stressed from people who sleep peacefully at night. The first goal of saving should always be protection. That means building an emergency fund, 3 to 6 months of expenses sitting in a safe account, so when life throws you a flat tire, a medical bill, or a sudden layoff, you're prepared. You don't need to swipe a credit card and fall deeper into debt. The second goal of saving is growth. This is where the magic of compound interest begins to work. Take this example. If you start saving $100 a month at age 25, and you invest it in something that averages 8% a year, by the time you hit 65, you'll have over $600,000. If you wait until 35 to start, you'll end up with less than $300,000. That's the power of starting early. Time multiplies your money. The trick is to pay yourself first. Don't save. What's left over, save before you spend. Set up an automatic transfer so that the moment your paycheck hits, a percentage goes straight to savings or investments. It removes temptation, it removes decision fatigue, and it builds discipline without effort. Another trap to avoid is lifestyle creep. That's when every time you get a raise, you instantly upgrade your lifestyle. New car, bigger, apartment, fancier, vacations. Suddenly the extra income is gone and you're still living paycheck to paycheck. The difference is now your expenses are higher. The smart move is to freeze your lifestyle. When your income goes up, keep the same car, keep the same apartment, but let your savings rate jump. That's how wealth grows quietly in the background. Saving isn't about deprivation, it's about building freedom. Every dollar you save is a soldier working for you. It's earning, it's compounding, it's creating choices for your future, and once your savings are growing, the next move is to make those dollars work even harder. That's where investing comes in. Saving money protects you, but investing money grows you. If you only save, you'll always be limited by what you earn. But when you invest, your money starts earning for you. This is the shift from working for money to making money work for you. And it's the real engine of wealth. There are several types of income-producing assets, each with different levels of risk and reward. Real estate is one of the most common paths. Picture buying a small duplex in Ohio for $150,000. You rent out one side and live in the other. The rent covers the mortgage. Over time, the property appreciates, you gain equity, and eventually you own an asset that pays you every month. That's how many families in North America build long-term wealth. Dividend-paying stocks are another option. These are shares in companies that pay part of their profits back to shareholders. Think about companies like Coca-Cola or Johnson & Johnson. They've been paying dividends for decades. Every quarter you get cash just for owning the stock, and if you reinvest those dividends, your snowball grows faster. Bonds are safer but slower. When you buy a bond, you're lending money to a government or company. They pay you interest on schedule. It's not flashy, but it's predictable. Bonds balance out the volatility of stocks. Then there's investing in small businesses or even starting your own, riskier, but the upside can be huge. Maybe you start an online store that earns a few $1,000s a month. That income can be reinvested into stocks or real estate. Over time, it becomes another income stream working for you. The key with investing is consistency. Don't wait for the perfect time. Don't chase quick wins. Start small, invest regularly. Reinvest your profits and let time and compounding do the heavy lifting. The more assets you own, the less dependent you become on your job. Your salary becomes optional. Your assets pay the bills. But there's something that can quietly destroy all that progress if you don't deal with it. Debt. Debt is one of the biggest obstacles to building wealth. It silently eats away at your income. It keeps you stuck in a cycle of working harder without moving forward. Credit card debt is the most dangerous. The average interest rate in North America is over 20%. That means if you owe $10,000 and only make minimum payments, you could end up paying more than double that amount over time. The first step is to face the numbers. List every debt you have, the balance, the interest rate, and the minimum payment. Seeing it all in one place is uncomfortable, but it gives you the clarity to create a plan. There are two popular strategies to pay off debt: the snowball method and the avalanche method. With the snowball method, you focus on paying off your smallest debts first, while making minimum payments on the others. Each time you knock out a small debt, you gain momentum. You see progress, and that motivates you to keep going. With the avalanche method, you focus on the debt with the highest interest rate first. This saves you the most money in the long run, because you cut down the amount of interest you pay. Both methods work. The best one is the one you can stick with consistently. Every extra dollar you put toward debt is one less dollar wasted on interest. Think about it like this. If you're paying $200 a month in credit card interest, that's $2,400 a year. Money that could have gone into savings or investments. Once the debt is gone, that cash flow is freed up. It can now go toward building wealth instead of paying for the past. The other side of debt management is prevention, living within your means, avoiding unnecessary borrowing, and resisting the urge to finance everything from furniture to vacations. When you eliminate debt and stay out of it, you give yourself a massive advantage. You create breathing room and you create momentum. Debt freedom isn't the end goal, it's the starting line. Because once you no longer owe anyone, you can finally focus all your energy on building wealth. And the fastest way to accelerate that wealth is to master one habit. Most people ignore living below your means. Living below your means doesn't mean living without joy. It means designing a lifestyle where your expenses are always less than your income. It's the simplest wealth strategy, and the one most people fail to follow. Here's why it matters. Every dollar you don't spend is a dollar you can save or invest. That dollar can grow into 5, 10, or even more over time. But if you spend it today on things you don't really need, it's gone forever. Many people in North America fall into the trap of lifestyle inflation. They get a raise, and instead of saving it, they upgrade their car, move into a bigger house, or start eating out more often. Their income rises, but so do their expenses. The result is the same paycheck-to-paycheck cycle. Only now it costs more to maintain. Wealthy people think differently, often drive used cars. They live in homes they can comfortably afford, and they don't waste money trying to look rich, because they understand that real wealth is quiet. It grows in the background while others are busy showing off. Here's an example. Imagine two friends both earning $75,000 a year. One buys a new SUV with a $700 monthly payment. The other drives a used car with no loan and invests that same $700 each month. Fast forward 10 years, the first friend has a depreciated car and no savings. The second friend has close to $150,000 invested, same income. Different choices. Living below your means is not about depriving yourself, it's about being intentional. Cooking at home instead of spending $200 on takeout every week. Choosing a modest vacation instead of going into debt for a luxury trip. Saying yes to the future instead of just the present. When you master this habit, you create a gap between what you earn and what you spend. That gap is the fuel for saving, investing, and building financial independence. Living below your means gives you freedom. The freedom to take risks. The freedom to walk away from a toxic job. The freedom to invest in opportunities without fear. And once you've created that freedom, the next step is to expand your income potential. That's where high-income skills come into play. Your job may limit your salary, but your skills can expand your income. High-income skills are abilities that people and businesses are willing to pay a premium for. They are personal assets that no one can take away from you. Think about coding. A software developer in the US or Canada can earn over $100,000 a year, but even outside full-time jobs, freelance developers can earn $50 to $100 an hour from anywhere in the world. Digital marketing is another example. Businesses need customers, and if you know how to bring in sales using ads, email campaigns, or social media, you instantly become valuable. Some marketers charge thousands of dollars a month to manage just one client. Sales and negotiation are timeless skills. Every company needs people who can close deals. If you can sell effectively, you can work in almost any industry, from real estate to tech, and your earning potential has no ceiling. Leadership and management also count as high-income skills. People who can guide teams, make tough decisions, and deliver results often move into higher-paying positions faster than their peers. Here's a story. A nurse in Toronto earning $60,000 a year decided to learn coding on the side. After a year of study and freelance projects, she switched careers and doubled her income. That extra income allowed her to pay off debt, max out her retirement accounts, and start investing in real estate. The best part about high-income skills is that they compound. The more you learn, the more doors open. You can start with one skill, then stack others on top, each one increasing your value in the marketplace. Don't wait for opportunities to come to you. Create them, ask for a raise when your skills grow. Apply for better jobs, or start a side business that uses what you know. High-income skills aren't just about making more money today. They are about building long-term security. Because once you own the skills, you can earn no matter where you live or what company you work for. When you combine living below your means with growing your income through skills, you create a powerful cycle. Your expenses stay low, your income rises, and the gap between the two grows larger every year. That gap is where wealth is built, and the easiest way to lock in that growth is by using systems. The system that makes this effortless is automation. Willpower fades. Motivation comes and goes. That's why the wealthy don't rely on discipline alone. They rely on systems, and the most powerful system you can set up is automation. Automation makes saving and investing automatic. Instead of deciding every month how much to put aside, you create transfers that happen on their own. Your paycheck comes in, a portion goes straight into savings. Another portion flows into investments, and you never even see it in your spending account. This is called paying yourself first. It means your future gets funded before you start spending on anything else. It flips the script. Instead of saving what's left after bills and fun, you spend what's left after saving. Let's take an example. Imagine you earn $4,000 a month. You set up a direct transfer of $500 into a high-yield savings account. Another $500 into an index fund. That's $1,000 invested every month without you lifting a finger at the end of a year. That's $12,000 saved and invested without a single decision. Automation also protects you from emotions. Markets go up and down. When they drop, most people panic and stop investing. If your investments are automatic, You keep buying at lower prices without even thinking about it. This is dollar cost averaging, and it's one of the simplest ways to build wealth steadily over time. The more you automate, the more consistent you become, and consistency is what builds real wealth. Not one big win, but small repeated actions stacked month after month. Another hidden benefit: when money leaves your account automatically, you naturally adjust your lifestyle to what's left. You spend smarter, you make better choices, because you know what's available is what you can truly afford over time. This system creates a snowball effect. Your savings grow, your investments compound, and your financial foundation gets stronger without extra effort. Automation keeps the engine running. But every engine needs protection from unexpected storms. That's why the next step is about spreading your money across different places. Diversification keeps your wealth safe while it grows. Imagine putting all your money into one stock. It grows for a while, then one bad headline makes it crash. Half your wealth is gone overnight. That's the danger of not diversifying. Diversification means spreading your money across different types of assets, so if one area struggles, the others keep you steady. Stocks are the growth engine. They give you ownership in companies, and over time, the US and Canadian stock markets have grown consistently, even with recessions and crashes along the way. Index funds make this simple. Instead of trying to pick the next Amazon or Tesla, you buy a basket of hundreds of companies at once. If one company fails, it hardly moves the needle, but when the economy grows, your investment grows too. Bonds are the stabilizers. They don't usually make you rich, but they provide steady interest and reduce risk when markets fall. Think of them like the brakes on your financial car. They keep things from spinning out of control. Real estate is another layer of diversification. It's tangible. It can provide rental income every month, and historically it tends to appreciate over time. Plenty of middle-class families in the US have built wealth just by holding on to one or two properties over decades. You can also look at alternative assets, things like gold, commodities, or even small businesses. These don't always move in the same direction as the stock market. That means when one part of your portfolio is down, another part might be up. Here's an example. During the 2008 financial crisis, the stock market lost nearly half its value, but investors who held bonds and real estate saw smaller losses and recovered faster. Diversification didn't eliminate risk, but it kept them from losing everything. Your mix will depend on your age and goals. If you're young with decades ahead, you can afford more stocks for growth. If you're closer to retirement, you may prefer more bonds and stable income investments. The important part is balance. No single investment should decide your future. A well-diversified portfolio gives you protection and peace of mind when markets get rough. Spreading your money is smart, but there's another piece many people forget. It's not just about what you earn, and it's not just about what you invest. It's also about how much of your money you get to keep after taxes. That's where tax advantages become your secret weapon. Taxes are one of the biggest expenses you'll face in your lifetime. For many people in North America, taxes take more money than food, housing, or even health care. That's why learning to use tax advantages is not optional. It's essential if you want to build wealth faster. The government actually gives you tools to save on taxes, but most people never use them. Retirement accounts are the most powerful example. A 401k or a traditional IRA lets you put money in before taxes. That means if you earn $60,000 and contribute $6,000 to your 401k, you're only taxed on $54,000. You pay less in taxes now, and your investments grow tax-deferred for decades. When you retire, you'll pay taxes on withdrawals, but by then you may be in a lower tax bracket. A Roth IRA works in reverse. You contribute after-tax money, so you don't get an upfront tax break, but the money grows tax-free, and when you withdraw in retirement, you pay zero taxes on your gains. If you invest consistently in a Roth IRA starting at age 22, even just $6,000 a year for 10 years, that account alone could grow to over $1 million by retirement. Another hidden gem is the Health Savings Account, or HSA. If you have a high-deductible health plan, you can open one. Your contributions are tax-deductible, the money grows tax-free, and when you use it for medical expenses, your withdrawals are also tax-free. That's triple tax advantage. No other account offers that beyond accounts. There are smart tax strategies you can use. Tax loss harvesting is one. If you sell an investment at a loss, you can use that loss to offset gains from other investments. That means a lower tax bill while keeping your long-term plan on track. Deductions and credits are another area where people leave money on the table. Things like retirement contributions, charitable donations, education credits, and even home office deductions for people working remotely can all reduce your taxable income. The more you learn about taxes, the more money you keep, and every dollar you keep is another dollar that can grow. Saving and investing is powerful, but pairing it with smart tax planning supercharges your wealth building. It's like giving your money a longer runway to grow. Once you've mastered taxes, there's one more ingredient that ties everything together: the commitment to keep learning, improving every single year. Money habits matter, but the mindset behind them matters even more. The people who build lasting wealth share one trait: they never stop learning. Financial literacy isn't something you check off a list, it's a lifelong skill. The world changes, markets shift, new technologies appear, and the economy goes through cycles. If you're not learning, you fall behind. Start with the basics, understand how budgeting works. Learn the difference between good debt and bad debt. Know what compound interest really means. These basics form the language of money, but don't stop there. Expand into investing. Read books on stock market history. Listen to podcasts about real estate. Take online courses in areas that interest you. Learning isn't just about finance, it's also about building skills that raise your income. Maybe it's public speaking, project management, or digital marketing. Each skill you develop makes you more valuable in the marketplace. Here's an example. A man in Chicago worked in retail for years. He decided to take night classes in data analytics. At first it was confusing, but he kept going. Within 2 years, he switched careers and doubled his salary. That decision didn't just increase his income, it accelerated his entire wealth-building journey. Learning from mistakes is just as important as learning from books. Plenty of people lost money during the crypto hype, some quit investing altogether. But the ones who studied what went wrong, who adjusted their approach, came back stronger. They used the failure as a lesson instead of a defeat. Surrounding yourself with the right people also matters. Join groups where money and business are openly discussed. Connect with mentors who are ahead of you, listen more than you talk, and apply what you learn quickly. Education without action is wasted. Every new piece of knowledge should lead to a new habit, a new decision, or a new opportunity. The more you learn, the more confident you become, and confidence is what allows you to take calculated risks. It gives you the courage to invest when others are afraid. It helps you stay calm when markets shake. Knowledge is leverage. It multiplies every dollar you save, every asset you buy, every skill you build. We've now covered the complete path from budgeting to saving, to investing, to crushing debt, to living below your means, to building high-income skills, to automating your money, to diversifying, to keeping more through tax advantages, and finally to committing to lifelong learning. This is the blueprint for building wealth from scratch, not through luck, not through shortcuts, but through disciplined strategy and persistence. Wealth is not built in a day, it's built day by day. Every choice you make adds up, every dollar you save is a building block. Every skill you learn is a new tool. Every year you stay consistent brings you closer to financial independence. You don't need to win the lottery, you don't need to wait for the perfect job, you just need to take the first step today. And keep walking the passive path. If you want to live with freedom, if you want money to work for you instead of against you, start now. Budget wisely, save consistently, invest patiently, and keep learning. This is how ordinary people become millionaires. This is how you create a future that feels secure. This is how you take control of your financial life. Stay focused, stay disciplined, and stay committed to your goals. Thank you for watching The Passive Path. If this video gave you value, hit like, subscribe for more, and share your biggest financial goal in the comments.